The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Andy Duncan, keeping you up to date with expert opinion on precious metals and the markets.
Welcome to this Gold Money Podcast on the 21st of January. This morning I'm speaking to Gordon Kerr, who's a financial engineer and a debt capital markets specialist. He writes for the Cobden Centre and he also works for its offshoot, Cobden Partners, and their purpose is to help European governments stabilise their financial systems. Hello, Gordon.
Good morning, Andy.
Your big claim to fame is that you played a significant part in wrecking the European banking system. Can you tell us how you achieved this kingly goal?
Thanks very much for that accolade, Andy. I think it's something that I only really realised after the event. The name of the game throughout the 90s and early noughties was regulatory capital arbitrage. I'd worked in a variety of sort of frontline jobs in structured finance, and I found myself around about the turn of the millennium working for a British bank which tried to present itself to the stock market as a mortgage bank, but in reality had a large fund of supposedly highly rated securities. About 4 billion of these securities were insured by the same American triple monoline insurance company. Our bank was running pretty short of capital. I think we'd issued a mandate to another bulge bracket investment bank to raise new share capital. But a colleague of mine really worked out very quickly an arbitrage that existed between the capital required to support this 4 billion portfolio, essentially bonds and loans, and the capital that would have been required if it was in derivative format. Obviously, at that point, credit default swaps were becoming very much a focus of our attention as a structuring tool, and motivated primarily by the desire to free up capital or create fake capital, as I prefer to call it.
Can I just break in there and ask you, why were you short of capital? Was that a regulatory restriction or were you actually short of real money?
I believe it was a regulatory restriction, although I was never actually told. But obviously we're doing returns to the Bank of England every day, every week, and we knew that the numbers were getting very strained. The effect of essentially converting the portfolio from loan format into credit derivative format freed up 15/16 of the 320 billion pounds or dollars required to support this 4 billion portfolio. And the way it was done was very simple. We simply went to New York, persuaded the monoline insurer to accept another basis point on the portfolio for agreeing to wrap or insure the same assets a second time, provided, of course, that they could only be exposed to one claim against the assets. At the same time, because of the fashions in investment banking and, banks all like to copy the herd, there was a bunch of foreign banks in London who were desperate to write more derivative business with us, especially if they could get AAA ratings on the assets, because they themselves obviously are exposed to the same kind of rating-driven and capital assessments. An Italian bank have been pestering us and taking us to lunch and so forth. And we obviously lined the whole trade up. Right, we asked them to write protection against this 4 billion portfolio to us, in return for which they had protection provided for them through the monoline insurer who was already guaranteeing the assets. I call it a sort of pig on pork transaction. The Italian bank was very happy. The day the deal was done, we appeared to have $300 million more in capital than we had the day before it. And of course, the other hidden benefit of putting risk into credit default swap format is it enables the vast bulk of the hoped for future earnings on the assets to be booked in that present accounting year. So I think that transaction accounted for about 10% of the bank's declared profit in that calendar year, which I think was 2000 or 2001. I became very worried about this within a few months because I realized that, of course, nothing can be copyrighted in banking and people change jobs very quickly and so forth. And within a year, I realized that this transaction style had spread like wildfire around the European banks. So I don't know in particular whether American banks were interested in this kind of activity. I've read a lot of stuff in the last couple of years about the American banking system being regarded as more on its feet than the European banking system. But certainly a lot of the travails of the European banking system, I think, can be rooted in transactions such as this. The other upshot from this was, of course, regulation of these banks becomes very difficult when the capital figures include retained earnings and profit calculated on this kind of basis through credit default swaps being attached to asset portfolios.
It sounds very much to me, if I try to put this into layman's terms, it's a bit like me selling my car to myself reinsuring it with the insurance agency for an extra £10. They're happy to do that so long as I only put one claim in against them. I somehow can then book a profit because I've sold a car to myself. And lots of people were pestering me by taking me out for lunch, which is a great thing to do at any time. Does that kind of sound a bit like what it was in layman's terms?
Kind of like that, I think, yes.
Was it virtually every other European bank adopted your scheme? And was this all prior to 2008?
Yeah, this would all be done in the years 2000 to 2005. And I think by then, of course, it could only be done for banks who had substantial portfolios of assets that were already guaranteed or wrapped by one of these AAA monolines. The whole thing ended in 2005 anyway, because that's when the new global Basel II rules came in. And what I find quite astonishing about the regulatory response to this, because it's crystal clear that they were looking at these transactions, was that rather than, tighten this up, the response by allowing banks to either, if they're mega banks, internally rate their own assets, or if they're smaller banks, rely on the established rating agencies, the regulatory response was simply to say that if you have AAA assets, you benefit from the reduced amount of capital in the first place.
So they were helping you do what you were trying to do, which was really leverage yourself on your AAA assets.
Absolutely. Any bank that claimed to have assets insured by these monolines, all of whom, of course, went bust, any bank that claimed that these assets were top quality without bothering to do a transaction such as this from the year 2005 could simply write back 15/16 of the capital that had supported them previously. So the effect of Basel II was, in that respect, greatly to re-leverage the banking system.
Did this 2008 Basel II initiative, do you think it caused the crash in some way? Do you think it triggered the crash, or was that just coincidental?
Well, I think having looked very closely at all kinds of weird and wonderful structures from a relatively early age, I think every one of these global regulatory initiatives played a reasonably significant step in taking the crash forward. I think that the problem with regulators is that they just don't seem to understand the basic differences between loans and equity, between subordinated debt and other levels of debt. They don't understand how to make rules relating to one or two specific classes of instruments or tranches of capital, that these rules will just get gamed out of existence. I'll give you another example, because I think a lot of this coincides more or less with the coincidence of timing of my age and career. Having started in banking in the early 80s, I was aware, just working in retail banking for a couple of years, I was reading about structures in the Financial Times. There was a fairly heavy issuance between the British banks of subordinated debt instruments, most of which were bought by other British banks. So there's a kind of circular little cartel going on. Whatever the regulatory rules that were applicable at the time, and this obviously is pre-Basel, it became advantageous for banks to show that they had greater amounts of capital by issuing subordinated debt that was simply bought by other banks. So, of course, the regulator spotted that in, 84, 85, and made one of the rules that has remained a kind of cornerstone of all the Basel guidelines, that banks holding of other banks' capital is deducted from its own capital, and that ended that particular merry-go-round. It's worth pausing on how on earth that situation got to that level in the early 80s in the first place, pre-Basel.
Beforehand, I was buying your car and you were buying my car. That one got sussed out. So then we started reinsuring each other's cars to kind of get around the situation.
Yeah. I mean, I really believe that when I look at the sheer complexity, obviously the problem with discussing the global banking system is it's just too big a subject. So I'm choosing to focus my couple of examples on British banks, although I've spent a great deal of time working for American investment banks. But I really feel that the belief today that somehow the American banking system is back on its feet because they've responded better to post-crisis rules is completely false. I think the American banking system is almost certainly very much on the very edge, because principally none of the incentives to do these credit default swap type structures and all the offshoots from them, CDOs and CDO squares, none of those appear to have changed. All the stuff I read about Basel III coming in 2019 is going to preserve the main incentives of putting assets into credit default swap format, because they enable the upfronting of profits that haven't yet been earned and generally have more advantageous official capital attributes. Go right back to the early 80s, you see that if there'd been any kind of sort of market test operating here, or any transparent disclosure and so forth, then the banks, I think, would have had these activities kind of reined in.
So just taking a step back then, so you're saying that even after the 2008 events, the regulators didn't fix the regulatory system. So I hate to use the word fix in terms of the LIBOR fixing scandal, but you're saying that everything is not fixed now.
Very much so. I'm extremely concerned about the European banking system in particular. I've spent a lot of time working on structures dealing with the new rules, and one in particular that jumps out is the failed sale transaction. So it's just one example of 100 structures that I have, seen or had presented to me or worked on since, say, 2009, early 2010. And the failed sale transaction basically is going to ensure that the next time the European banking system or a country's banking system visibly flips over, as opposed to get perpetually propped up by the European Central Bank, then you'll find that not only will the depositors be unable to have their deposit calls for cash answered, but the bulk of any quality assets will have been hypothecated. Talk briefly about failed sale. This is a response to the Lehman collapse. Everybody crawled over the Lehman carcass and concluded that because they'd been parking assets and liabilities on reporting dates through repo operations, which generally fall under the category of securitization, that there was something essentially wrong with securitization as an instrument. Securitization has been clamped down upon. Again, I fundamentally disagree with that. Securitization is a very healthy method of preventing banks cartelizing certain business streams and protecting their profits from market competition. But the failed sale transaction in particular was a response to a rule that, in a nutshell, made it far more difficult for banks to achieve off-balance sheet treatment for securitizations. This again, you look at the SIV structures and so forth, which had to be reconsolidated when certain bank assets failed.
Can you just explain SIV to our listeners?
SIV is a general term for a structured investment vehicle. So take an ordinary banking activity such as creating car loans. Again, banks wanting to leverage themselves to the greatest extent possible would establish off-balance sheet entities that would be the purchasers of large securitized chunks of these car loans. And the problem being that in the crisis, for various reasons, banks chose to reconsolidate those SIVs onto their own balance sheet. Clearly, there was a fundamental problem with the accounting rules in the first place if a bank felt so obligated towards the investors in the SIV that it had to do that. The last thing the regulators should have done was design the kind of securitization rules that came into play, I think, in 2009, because then they opened the avenue for this failed sale structure, which, very simply put, exploits the fact that assets which have been mortgaged or hypothecated in that way to a third-party investor never leave the balance sheet of the original holding bank. And so, of course, we're in this crazy world right now where everybody knows that nearly all the major banks, and many of the minor ones, are insolvent in any ordinary sense of the term, only being propped up by repeated bailouts and QE. And for that reason, the LIBOR market, about which you read so much recently, is dead. LIBOR, the London Interbank Offered Market, was a wonderful concept to advance the argument that banking is a healthy activity. Clearly, if banks have confidence in each other, they will lend on an unsecured basis to each other at the London Interbank Offered rate. But that activity doesn't go on anymore. Nearly everything takes place through secure transactions, and many of them are these failed sale structures. So Bank A will persuade the bank wanting to borrow money from it, Bank B, let's call it, to pledge prime quality assets, collateral, to the lending bank. It's just a long-term repo transaction, but under the bulk of the accounting rules, and of course this is again a complex subject, so I'm sure there'll be somebody listening in one country that might be able to question this, but in general, if structured properly under the Basel failed sale rules, the assets will always remain on the reported balance sheet of Bank B, even though Bank A has a secure prior legal claim over those assets. So should Bank B fail, the assets will just be snatched by the liquidator on behalf of Bank A.
Okay, so where do you see this going then? Everyone seems to have been tied into a corner. The poachers and the gamekeepers have been fighting a regulatory war. The poachers are earning £500,000 a year salaries. The gamekeepers are earning £70,000 a year salaries. So the poachers have run rings around the regulators. But now we're in this kind of corner where everyone's tied up and twisted up. Where do you think it's going to go next?
Well, I would love to sound, optimistic. In fact, Andy, I will sound optimistic. I think that has often been written about when you have a crisis of this nature, some kind of collapse is inevitable. It may well be of such a level that it is the trigger that many investors in gold money products would have been waiting for. It may well, in fact, bring down paper money systems. It shouldn't. There should be, a consensus approach to look sensibly at this and come up with a better solution. But I think so many regulators, politicians, senior individuals who have influence on these matters have so closely tied their reputations to these global Basel guidelines and things like the European accounting rules, that I think there will be an inevitability to the way this plays out. The European Central Bank has announced it will do whatever it takes to save the euro, by which it means the European banking system. So I think we can expect more QE and banking support ad infinitum.
Now, I'm a completely free market man myself, and I just want the market to be allowed to work and to clear out all of these kind of failed and failing financial companies in the kind of Joseph Schumpeter creative destructionism kind of thing. But I'm just going to pretend for a couple of minutes to be someone who believes in government regulation. What measures do you think they should bring into place now to stabilise this system?
I would agree governments have a major and important role to play, Andy, at this stage. You can't go from chaos to nirvana overnight. I think the most important thing for the European governments to look at, and I'm pleased to say that I believe the European Commission are reported to be looking at this right now, are the accounting rules. I know accounting is just about the most boring subject, and I hope there's not a mass switch off of the podcast, but I think if you have a situation as we have under the European accounting rules, to give you just one example of a whole raft of silly rules, we have a situation whereby banks are prevented from recognizing in their books provisions for loans that they expect to default in the very near future. This was highlighted with a little bit of research that I was part of in the spring-summer of 2011, where we have the major UK bank, RBS, bailed out to the extent of about £45 billion by the taxpayer, 82% owned by Her Majesty's government, producing its reporting accounts for the year ended December 2010, where the bad and doubtful debt figure, their expected losses, were booked as something like 37 billion, and yet the government's own bad bank insurer valued the same assets, funny enough using the IFRS European accounting rules, but this time as an insurer as opposed to as a lender. The insurer rules require some assessment of bad and doubtful debt. So the insurer of RBS valued the same assets as about 19 to 23 billion pounds worse. Difficult to be more specific than that 4 billion gap because of the differences to the reporting dates between the bank and the insurer, called the Asset Protection Scheme. So Steve Baker, Member of Parliament, very independent thinking lawmaker over here, and my small team were talking about this, and Steve agreed to put out a press release which flushed out the Royal Bank of Scotland. They demanded a meeting as to why Steve and others were saying that they were falsifying their profits and capital figures to the tune of underreporting 19 billion pounds of losses. I fear that is be clear about this, which is virtually twice the cost of the 2012 London Olympic Games. And the meeting took place at the end of May 2011 in the British Parliament, at which I was present. And when these points were put to the three senior RBS executives, they simply said, well, that's somebody else's view of the value of our loan portfolio. I thought this was rather rich, given that the individuals around the table clearly had a personal vested interest in minimising the expected losses. And I put it to one of them. I said, do you mind me asking, were you doing your kind of job at RBS when the bank fell over in 2008? To which the answer was yes. So my view was, I would be slightly more happy to rely on the views of a third-party assessor of the loan value than these individuals. And sure enough, substantial losses have been booked again and again and again. What I find astonishing about RBS's decision-making in 2012, and this is just a speculative opinion, I don't have any evidence other than just logic to back this up, is that they removed themselves from this government asset protection scheme sometime in 2012. Well, the way the British government's continued guarantee for RBS had been operating was that once the cumulative losses of RBS, through their bad bank in particular, reached 60 billion, then the taxpayer would insure 90% of all the losses on what they call a vertical slice basis. So a 10% first loss slice was retained for moral hazard reasons by RBS. The cost of this insurance policy was £700 million a year, which is relatively cheap for the amount of cover, unlimited cover on the balance sheet of a £1 billion bank. And the cumulative losses, I calculated, had reached about £45 billion by early 2012. And as I said, the government insurer expected the cumulative total to reach 57 billion. So they were very near to the point when that insurance policy would attach. Why on earth would RBS cancel that policy? I wonder whether the true reason is to stop scrutineers such as me and my team actually pointing out this false accounting nonsense every time they produce their accounts. But the effect of cancelling that cover obviously lets the British taxpayer off the hook in one sense, although whether we'll see some further efforts to bail out RBS, I'm not sure. But I think the effect of the commercial rational acting manager to cancel a policy like that is a bit like having a house on the Jersey Shore a few weeks before Hurricane Sandy hit and cancelling your home cover policy just to save a few dollars on the premium.
Yes, 19 billion here and 19 billion there, and sooner or later we're talking about real money. Now, we just had the new Basel III arrangements put into place on January 1st in most kind of European jurisdictions. Just getting less technical, and I almost lost the will to live there when you said IFRS accounting. But what's your outlook for 2013 as far as the kind of European banking scene goes?
I think 2013 will continue to be a bumpy year. I think the banks are all extremely leveraged, and I think some kind of banking meltdown is inevitable. The problem is we now have official policy of near zero interest rates forever, as we know from the sovereign bailout of Greece, the second one in November 2012. The only conceivable way that the new magic sovereign debt to GDP ratio of 120% can be achieved in 10 years' time assumes, all kinds of government measures, but constantly a virtually zero interest rate environment. As soon as interest rates go up by even 1 or 2%, none of these European super regulators will even be able to maintain the pretense that there's any hope of sovereign solvency. So I think we know that banks are going to be operating in a near zero interest rate environment. I think politically there's going to be a lot of negotiations around the new three-stage measure for European federalisation. This was announced in December. The ECB recognises that the structure of the common currency without real national government integration was deeply flawed. They've said that, and one of the building blocks to integrate European countries at a federal level is to have a kind of super regulator appointed to supervise their banks. But I do think this is rather like discussing the colour of the flannels on the deck chairs of the Titanic at the moment.
The Cobden Centre and Cobden Partners look a lot at the British system. I'm going to give you a magic wand, and with this magic wand, I want you to solve the British financial problems that we have at the moment. What do you do, and in what order?
Well, there are two relatively straightforward legal measures. The first one, extremely simple, which is a piece of legislation which Cobden Partners sort of co-drafted in 2011 that was laid before Parliament by the same Member of Parliament I mentioned earlier, Steve Baker, which would simply repeal the European accounting rules that make the job of regulators virtually impossible by masking insolvencies in the ways I just described. This bill would simply peel back the IFRS accounting rules, restore the primacy of the 2006 Companies Act, which has a perfectly coherent working set of accounting rules that would have, would present a far truer, more accurate picture of profits and capital. Second thing I would do is I think again about Kevin Dowd's excellent research on unlimited liability. I think we've got a situation now where managerialism has taken over banks to such an extent that people have, I have zero confidence that regulators can make any dent in this constant story of bailout failure. I think the British banks in particular have been on the edge for virtually my entire career. They have openly failed several times. I remember there being huge rights issues towards the end of the 80s, again in the early 90s, all kinds of long-dated, stored-up problems on their balance sheets, banks going into all the wrong areas of business as far as I can tell, and this is all driven by managers' desire to maximize their short-term compensation, short-term careers, and shareholders and investors being virtually disinterested. In the case of RBS, with the government as an 82% shareholder, we've got a very, very worrying situation because I don't really think that the UK civil servants are anywhere near as sharp as some of the institutional investors that I've met. And I think unless you can connect shareholders and managers with personal exposure to the health of these banks, then we're going to be always seeing these managers driving their cars off the edge of the cliff.
Okay, as von Mises said, human actors always act in their own interests all the time. So we need to develop systems which get around that. I mean, in my opinion, that would be the free market, which would sort all of this out. But that isn't the world we live in at the moment. Now, this is gold money, so I have to ask you, what effect on gold do you think all of this is going to have? Do you see that we're going to go into a banking crisis in which there'll be a gold money put forward to solve the problems?
I think it's very difficult to think of a specific trigger, which hair is going to break the camel's back. We discussed earlier how subprime, I think, has been sort of misreported as the cause of the crisis, whereas I think it was the structuring and incentives around credit default swaps and instruments such as that was the cause of the crisis, and subprime just happened to be the assets that were utilised to the maximum because of the huge appetite of the customers for credit in those markets. But I think the effect on gold will be that the realization will dawn on serious investors that their money is no longer safe, not only in these banks, but it's no longer safe in any sense relying on future government guarantees. Governments talk about doing everything they can to save banks and prop banks up, and it's a difficult one to call. It's clear that they will do that, but they simply don't have the resources to support banks at this level. And as the quality of management continues to deteriorate, as the level of integrity is openly exposed as completely unsuited to the taxpayer responsibilities that these managers bear, then I think there will be a crumbling of confidence. I've had discussions with a number of economists about this, and I suppose I think the point might be when interest rates on sovereign debt start to turn negative, when people realise that the actual cost they suffer by holding their cash in bank bonds or government bonds is just above the comfort level, and they prefer to take their cash out. And that could be a trigger point. But I think that some kind of gold money system will come into play. And I'm actually delighted that in the last 2-3 weeks, the chap Kerr I mentioned a couple of times has done some really groundbreaking research on new formats of introducing a gold standard.
Well, I really look forward to speaking to you about that. When will he have his kind of research out on that?
I think it should be in the next couple of months. There's some European elections coming up, and there's Cobden Partners. We go around talking to governments or opposition parties in European countries, trying to explain to the points that we've been discussing on this podcast and suggesting that they have a plan B up their sleeves, such as having an alternative currency designed and ready to go.
Well, that should be really interesting. So you'll have to let me know when you're ready to publish details on that. How long can you see the current European and British banking system going? What's the latest year in which it can stagger onto before everything has to give?
Of course, I have vested interest too. I mean, nobody wants to look like a fool, so I guess I've got a vested interest in saying 10 years, because it'll kind of be a safer prediction. But just looking at the numbers, looking at the way the bailouts are translating into rapidly increasing unemployment and shrinking of economies, I just can't really see this going on much beyond 3 or 4 years. I read an article in October observing that Greece's economy had shrunk not 14%, but 40% in the year November to November 2012. But when you look at the corporation tax receipts, who knows what the size of an economy is these days with so much government expenditure. So when you see Greece's corporation tax take reducing by 40% in the 12 months to November 2012, that tells me that the economy has shrunk by 40%. So there's no hope at all that Greece can ever service anywhere near the official level of debt that it's now had after 3 bailouts, 3 concessions, 3 episodes of forgiveness. So there's a hell of a lot of pain to come.
People are relying on government, but what they fail to remember is that governments have nothing except what they can tax, borrow and print. Do you actually see the situation going in Greece, or do you think it's going to move west a little bit to Spain?
All you can do is look at the repayments that are due on big wads of country debt coming up, and I guess everybody knows when they are, but for the time being you'll see this desire amongst the regulators to try to prevent visible insolvencies. So heavy deployment of open market operations by the European Central Bank and money printing and so forth. It just goes on and on. I mean, the size of the European Central Bank's balance sheet is now absolutely enormous, and the same for the Fed and Bank of England. The problem that people like you and I have in talking about this, Andy, is that you can see the parallels with Germany money printing in the early 1920s, but there you had essentially one country with unrepayable levels of debt printing money to try to get out of it, and within 2-3 years that crashed the currency. Because exactly the same measures are being adopted by every major central bank, every policymaker, this is just a massive thing, and it's just very difficult to predict when things are going to happen. I would stick with my guess, though, if you push me sort of 4 to 5 years.
So, Gordon, what you've said today is all very interesting. If anybody out there, or even any government financial treasury department, would like the advice of Cobden Partners and yourself and Kevin Dowd, the economist, how can they get hold of you?
Well, that's very kind, Andy. We'd love to talk to potential interested parties. We've got a website, cobdenpartners.co.uk, with a standard info address. My personal email address, gkerr, Kerr, at cobdenpartners.co.uk. And obviously our telephone numbers are published and so forth.
Well, I look forward to speaking to you about your currency ideas in a couple of months' time. Thank you for your time today, Gordon Kerr.
Thanks, Andy.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.
Or on its feet in the European banking system. But certainly the a lot of the travails of the European banking system, I think, can be rooted in transactions such as this. The other upshot from this was, of course, regulation of these banks becomes very difficult when the capital figures include retained earnings and profit calculated on this kind of basis through credit default swaps being attached to asset portfolios.
It sounds very much to me, if I try to put this into layman's terms, it's a bit like me selling my car to myself, reinsuring it with the insurance agency for an extra £10. They're happy to do that so long as I only put one claim in against them. I somehow can then book a profit because I've sold a car to myself. And lots of people were pestering me by taking me out for lunch, which is a great thing to do at any time. Does that kind of sound a bit like what it was in layman's terms?
Kind of like that, I think, yes.
Was it virtually every other European bank adopted your scheme? And was this all prior to 2008?
Yeah, this would all be done in the years 2000 to 2005. And I think by then, of course, it could only be done for banks who had Raj. I'd worked in a variety of sort of frontline jobs in structured finance, and I found myself around about the turn of the millennium working for a British bank, which tried to present itself to the stock market as a mortgage bank, but in reality had a large fund of supposedly highly rated securities. About 4 billion of these securities were insured by the same American triple monoline insurance company. Our bank was running pretty short of capital. I think we'd issued a mandate to another bulge bracket investment bank to raise new share capital. But a colleague of mine really worked out very quickly an arbitrage that existed between the capital required to support this 4 billion portfolio, essentially bonds and loans, and the capital that would have been required if it was in derivative format. Obviously, at that point, credit default swaps were becoming very much a focus of our attention as a structuring tool, and motivated primarily by the desire to free up capital or create fake capital, as I prefer to call it.
Can I just break in there and ask you, why were you short of capital? Was that a regulatory restriction, or were you actually short of real money?
I believe it was a regulatory restriction, although I was never actually told. But obviously we're doing returns to the Bank of England every day, every week, and we knew that the numbers were getting very strained. The effect of essentially converting the portfolio from loan format into credit derivative format freed up 15/16 of the £320 billion or dollars required to support this 4 billion portfolio. And the way it was done was very simple. We simply went to New York, persuaded the monoline insurer to accept another basis point on the portfolio for agreeing to wrap or insure the same assets a second time, provided, of course, that they could only be exposed to one claim against the assets. At the same time, because of factions in investment banking and, banks all like to copy the herd, there was a bunch of foreign banks in London who were desperate to write more derivative business with us, especially if they could get AAA ratings on the assets, because they themselves obviously are exposed to the same kind of rating-driven and capital assessments. An Italian bank have been pestering us and taking us to lunch and so forth, and we obviously lined the whole trade up. Right, we asked them to write protection against this 4 billion portfolio to us, in return for which they had protection provided for them through the monoline insurer who was already guaranteeing the assets. I call it a sort of pig on pork transaction. The Italian bank was very happy. The day the deal was done, we appeared to have $300 million more in capital than we had the day before it. And of course, the other hidden benefit of putting risk into credit default swap format is it enables the vast bulk of the hoped for future earnings on the assets to be booked in that present accounting year. So I think that transaction accounted for about 10% of the bank's declared profit in that calendar year, which I think was 2000 or 2001. I became very worried about this within a few months, because I realized that, of course, nothing can be copyrighted in banking, and people change jobs fairly quickly and so forth. And within a year, I realized that this transaction style had spread like wildfire around the European banks. So I don't know in particular whether American banks were interested in this kind of activity. I've read a lot of stuff in the last couple of years about the American banking system being regarded as more.
The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Andy Duncan, keeping you up to date with expert opinion on precious metals and the markets.
Welcome to this Gold Money Podcast on the 21st of January. This morning I'm speaking to Gordon Kerr, who's a financial engineer and a debt capital markets specialist. He writes for the Cobden Centre and he also works for its offshoot, Cobden Partners, and their purpose is to help European governments stabilise their financial systems. Hello, Gordon.
Good morning, Andy.
Your big claim to fame is that you played a significant part in wrecking the European banking system. Can you tell us how you achieved this kingly goal?
Thanks very much for that accolade, Andy. I think it's something that I only really realised after the event. The name of the game throughout the 90s and early noughties was regulatory capital arbitrage.